Welcome back into Lowcountry Money Talk, asking Phil some questions today and talking retirement, which of course could be the perfect storm. We've got some more to discuss. Does that sound good?
Yes.
I'm going to keep rolling with our questions. I know you want answers at home. I do too. We were talking about runaway inflation before the break, and you said, well, what happens if you need to take more out because you're dealing with inflation? My answer was make more. You reminded me that we also have to pay more taxes.
Depending on where we're taking the funds, yes.
Yes, okay. So let's go back to that make more though. So what are we going to be able to do? How do we protect our savings from the inflation issue that we're dealing with?
Okay, first of all, Jessa, we want to make sure we don't get in a trap. Okay, because I believe that, we always talk about the rule of 100, right? So if we have the right amount exposed to the market, and then we have, as we retire, we have a larger part that's not exposed to market risk, we should be taking our funds from the non-exposed side right now, let's say. But even on the market side, let's say that we're poised to think, okay, if we have this market pullback that many analysts are predicting, let's say it comes in the summer, they're debating this, the debt debate, the debt ceiling rise. It seems like they do that every couple of years. So the market may start responding to that, but so far so good. But if we do have a sell-off, I think we could get better pricing on stocks and equities later in the year. Okay. But what do we do till then to make some more money?
Right, yeah.
Well, what I've been looking at is like short-term treasuries. They offer like a 3 and 6 month treasury. So instead of just sitting in a money market at 1, if we think we're going to be sitting around for 3 to 6 months, maybe we can ladder some of these and get a better return on that money to help offset inflation, so that as we're waiting for those better purchase prices. Now, what we don't want to do is we don't want to get so much in treasuries that we miss the buying opportunities on the lower stock price.
Yeah.
So I would recommend 3 to 6 months, but I wouldn't really go longer with the money that I want to buy equities. Elsewise, you could be stuck.
Right, and then the prices are low and you're missing out on the great opportunity.
You're waiting for maturity on a 1-year treasury saying, well, hey, I'm getting 5%, but when these equities start moving, a lot of those could move that quick in a day or two. So.
Yeah, 5% sounds great right now, but in 6 months or so, hopefully we'll be able to start bouncing back.
We need to keep our funds on the right side of the table. So what we don't want at risk, we protect that. Maybe we're taking income from that side. What we do want at risk, we don't want to get long on treasuries, because we want that just to be a temporary thing, because we want these to be in equity positions and stocks and things of that nature. So don't get confused on, what's what, but just something now because of the state of the economy. Maybe we just take some short-term interest on those instead of setting dormant.
Right, and watching things unravel. Okay, so getting back to inflation here, talking about investments and risk, okay? So what are we going to do when we're looking at our different investments? Which ones are getting hit the hardest by inflation?
Well, it seems like if we look at our equity portfolio or our stock portfolio, we're kind of what we call running sideways. So we had the tech stocks started off real good to begin the year, and then we had a week where they just ran down. They came back on Friday. It seems like we're just kind of running in place a bit. So maybe sideways on the market. I think we're in a stagflation. I mentioned that last year. Watch out for that. I think we're there. Stagflation. The prices keep going up. Not really much movement on the economy. So I think we're here. So your question was, which parts of our investments are getting hit hard? Well, if we have money just sitting around and checking, we talk about an emergency fund, 6 months expenses. Well, why do we have 5 years expenses in there getting a 0%? A lot of people are pulling those funds and putting in short-term treasuries, and that's why the banks are having some big problems right now, because they're not paying us interest, so people are taking those funds out.
Okay. Isn't that interesting? Wow. Well, all right, we've got lots more questions to discuss, and this is such an interesting topic. We could be here all day. Maybe you'll stay with us. We'll be right back.